There are a range of different measures of portfolio evaluation that are used to determine the success or otherwise of an investment. In this learning objective, we're going to look at the application of the Sharpe ratio, M-squared measure, Treynor ratio, Jensen's alpha, and the information ratio. So first of all, the question, why do we go about evaluating performance? Well, it's important for us to evaluate how our asset performs for two reasons. One, we look at portfolio evaluation as the way of back-testing prospective investment strategies. So one way that we can help to determine whether or not there appears to be a sound scientific basis for our investment philosophy is to use historic data to back-test the performance of that strategy. Keeping in mind a backtest should not be the only foundation of our philosophy, given what we've seen before, that past returns aren't necessarily fully indicative of what we're going to see in the future. Portfolio evaluation also has a second purpose, that's to test and report investment performance. Okay, particularly in the delegated funds management industry, there are regulations that require the reporting of performance of particular funds. But even for individual investors, it's important to identify how an investor has performed and potentially feed that information in to the continual reworking and improvement of the investment strategy. So when we go about evaluating performance, there's a range of different measures that we might use. We can use measures that in all instances are looking at this trade-off between risk and return. However, there are different ways that risk and return are measured across those different evaluation measures. So first of all, the first group of measures look at mean variance measures. In these measures, they're looking at the trade-off between returns and risk as measured by standard deviation of returns. And those measures are the Sharpe ratio and M-squared measure. The second group of measures look at the trade-off between returns and risk, whereby risk is measured as beta. So we call these CAPM measures. And those measures are the Treynor measure and Jensen's alpha. Another group of measures looks at considering risk in terms of downside risk, given we've previously seen that investors maybe are more concerned about downside risk as opposed to upside risk. These measures are the Treynor ratio and risk-adjusted return on capital. Finally, investors also often engage in benchmarking. Benchmarking is whereby they compare their performance to some pre-identified benchmark as a way of controlling for risk and just comparing return performance. So starting with mean variance performance measures. So first of all, the Sharpe index or the Sharpe ratio. So we've got a pure risk-return trade-off here, where our numerator is the excess returns generated by the portfolio, or the portfolio's returns less the risk-free rate, and the denominator is the standard deviation of returns generated by that portfolio. And basically what we're looking at here is that a higher Sharpe ratio implies better performance. Now, a Sharpe ratio is just a ratio measure. The ratio itself does not have economic meaning in the sense that it gives us a measure of the degree of outperformance. The Sharpe ratio can only be used for comparing investments. That is, the higher Sharpe ratio, the better the investment. An alternative measure that also uses standard deviation as a measure of risk, however, has the added benefit that it can give us a measure of the magnitude of outperformance, is the M-squared measure. Basically what the M-squared measure does is that it takes the managed portfolio, or takes the portfolio you're seeking to evaluate, and it combines it with the risk-free rate in order to calculate a new hypothetical portfolio that has the same risk as the market, where risk is measured as the standard deviation of returns. Now, we can see down the bottom here an equation which is how the M-squared measure is calculated. But a better way to think about the M-squared measure is to work through it intuitively. So basically what we do is we take our risky portfolio and we weight the risky portfolio by the ratio of the standard deviation of the market to the standard deviation of that portfolio. Okay, what we're doing here is we're either leveraging our portfolio up if it is less risky than the market, or we're combining our portfolio with the risk-free rate if our risky portfolio is more risky than the market, such that we adjust the overall level of risk to be equivalent to market risk. Okay. Then we weight the balance, okay, or 1 minus that ratio, in the risk-free rate. Okay. We take the combination of those and we've effectively created a new portfolio that combines our risky asset and the risk-free rate together, And as I said before, the relative weightings are determined such that this new portfolio will have the same standard deviation as the market. We then subtract the market return off the end, and what we've effectively done is we've compared two portfolios that have the same standard deviation, so we've controlled for risk, and the difference in returns between our hypothetical portfolio in square brackets and the market return will give us the degree of over or underperformance. Let's think about this numerically. Let's imagine that we've got a managed portfolio that has a return of 35% and a standard deviation of 42%. Let's imagine the market over the same period had a return of 28% and a standard deviation of 30%. And let's assume the bank bill rate, the risk-free rate, was 6%. Okay. We could have calculated the Sharpe ratio of these. Remember Sharpe ratio, return less risk-free rate divided by standard deviation for both. And just based on the Sharpe ratio, we can see that the market actually outperformed our managed portfolio. Now the M-squared measure will always give an answer in the same direction as the Sharpe ratio, but it goes that one step further because it gives us a measure of the degree of over or underperformance. So what we can see here, our managed portfolio earned a higher return than the market, but it was also quite a bit riskier. Okay, so how do we compare these two? Well, we create a new hypothetical portfolio, combining our managed portfolio and the risk-free rate, and we create that hypothetical portfolio such that it has the same standard deviation as the market. So as discussed earlier, the way we do that is that we weight our hypothetical portfolio so that the weighting in our managed portfolio is the ratio of the standard deviation of the market over the standard deviation of our risky portfolio. So 30 over 42, coming back here, standard deviation of the market divided by standard deviation of the managed portfolio. So we put 71.4% in that managed portfolio, and we put the balance, 1 minus 71.4%, or 28.6%, in the risk-free rate in bank bills. So the return on this hypothetical portfolio, the expected return, is the weight times the return on our managed portfolio, which was 35%, plus the weight in the risk-free rate times 6%, which was the return on the risk-free rate. The return on this hypothetical portfolio was 26.7%. Okay? But we've now created a hypothetical portfolio that has the same risk as the market. Okay? This, by construction, has the same standard deviation as the market. So what we can actually do is we can just compare the returns. The return on the hypothetical portfolio less return on the market portfolio. And after controlling for risk, we can see that our managed portfolio has actually underperformed the market by 1.3%. Another way to think about that is that if we look at the capital allocation line, which is the trade-off between the expected returns and the standard deviation of any asset, we know that we've got the slope of that capital allocation line is the Sharpe ratio, because the slope is the ratio of expected excess returns divided by standard deviation. Now, we've got these two portfolios, P, our managed portfolio, and M, the market, and what our M-squared measure is doing is equating them, so moving P back down its capital allocation line by combining it with a risk-free rate, such that it has the same standard deviation of the market, and our M-squared measure is just then the difference between the two. Okay, if our portfolio had overperformed the market, what we might have found there is we might have found that this line was up above, and perhaps P was up here somewhere, and then when we combine it with the market, we end up with a value that is above M after controlling for risk. In that case, we would have found that our asset had outperformed the market. So that's the M-squared measure. The next measure that we look at in terms of evaluating performance relates to a CAPM measure. Now what we're looking at is the trade-off of expected returns and risk, whereby we're measuring risk as beta. So the Treynor measure, first of all, very similar to the Sharpe ratio from before, trade-off between returns and risk, only here we're measuring risk as the beta of the stock. So excess returns is the numerator, beta is the denominator. Just as the Sharpe ratio, higher Treynor measure means better performance, and we can use the Treynor measure to compare relative performance of stocks. Okay, so what we're looking at here really is the security market line. We can compare the security market line of various stocks where we plot excess return on one axis, beta on the other. The steeper the slope of the line basically means a higher Treynor measure to compare assets. Now again, one potential problem with the Treynor measure is that it doesn't give us a measure of the magnitude of outperformance. So a way that we can measure the magnitude of outperformance by use beta as a measure of risk is Jensen's alpha. Jensen's alpha is an adaptation of the CAPM, whereby it says we can estimate the expected return that a stock should have generated given its beta using the CAPM model. And we can see that here in square brackets, the risk-free rate plus beta times return on the market less the risk-free rate. That is the expected return, okay, the return we expect to generate given the risk-free rate plus the systematic risk and the risk premium. And we can compare that to the actual return of the portfolio. So here's the return we actually generated, less here's the return we should have generated given the risk we were taking on. And Jensen's alpha gives us a measure of the difference between those. Hence, once again, it's given us a measure of risk-adjusted returns. The next group of measures looks at downside risk as a measure of risk. So once again, it's a trade-off between returns and risk, but here we're focusing on a different type of risk. So the first is the Sortino ratio. Once again, looks quite similar to the Sharpe ratio, only this time our numerator is realized returns, the excess return on our asset, and the denominator here is the downside deviation. And what we mean by downside deviation is it is the standard deviation of all returns that are less than the mean. So what we're looking at here is the spread of only those opportunities that are the danger side of the danger and opportunity risk trade-off. Just the downside returns. And in that way, it's actually partially picking up for the effects of skewness as well as the effects of variance. An alternative way to look at a measure of downside risk is to look at the value at risk. And the value at risk gives us the measure of the observation that we get in the worst nth percent of occasions. Okay, often what we look at is the 5% VAR, which is the return value in the 5th percentile, or the bottom 5% of returns. With the risk-adjusted return on capital measure, once again, we've got excess returns as the numerator, but the denominator is the difference between our mean return and the 5% VAR. The 5% VAR being the 5th percentile of outcomes that we've achieved, or that cutoff point to where we start to get to the 5% of worst case scenarios. Now, once again, this is giving us this difference between the mean return and the 5% VAR is giving us a measure of the downside of that distribution. So once again, our denominator here is a downside measure of risk. We've got excess returns on top, downside risk on the bottom to get our risk-return trade-off. Now, we mentioned earlier that an alternative to looking at these measures of risk-adjusted returns is to consider benchmarking. So benchmarking is a technique whereby we say, well, the calculation of risk is quite opaque and quite difficult, so let's do away with it. And let's instead just equate the return of our portfolio to the return of some benchmark portfolio that's pre-identified. And the idea of that benchmark, it should have an equivalent level of risk to our asset, and hence all we can do is we can just compare the return of the two assets because we've effectively eliminated any concern with risk because we're comparing two assets that have equivalent risk. Okay, we then find that the manager's contribution is the difference between the portfolio return and the benchmark return. Now, most commonly, we find that investment managers will use a market index as a benchmark. So in Australia, for example, they'll use the ASX 200. That might be relevant in some situations, but the question is, well, is it relevant in all cases? Well, to answer that, we have to think about what are the characteristics of a good benchmark. And a good benchmark should be investable, so it should be something that can actually be replicated. It should have an unambiguous composition, so we should know how the benchmark is actually constructed, and we should know that in advance. It should be appropriate, and it should have equivalent risk to the risk of the asset that it's being compared to. It needs to be specified in advance, so a benchmark needs to be identified up front. You can't post-fit a benchmark to evaluate your performance after the fact. That's basically cheating. And it needs to be objectively constructed, so it can't be tilted in favour or against any particular manager. That's benchmarking. The last consideration in terms of looking at measures of portfolio evaluation is to consider the information ratio. And we use the information ratio as a way of measuring the performance of an active investor. Now, when we think about an active investing versus passive investing has both benefits and costs. The benefit of active investing compared with just passively investing in a market index is that you've got the potential to outperform the market. You've got the potential to generate alpha. If you're just holding the market, you can never outperform the market. Similarly, you'll never underperform the market. So the benefit, the pro of active investment is ability to generate alpha. But the problem with active investment is that you become less than perfectly diversified. A perfectly diversified portfolio is holding the market portfolio. Hence, through active investment, you're exposing yourself to unsystematic risk. So what we find with the information ratio is that it trades off the benefits and the costs of active investment. On our numerator, we've got the benefits, which is alpha, the ability to overperform or earn abnormal returns. On the denominator, we have this measure of unsystematic risk. And we look at the ratio of the two. The higher the information ratio, the better the active investor has actually performed. So that's a range of different techniques that can be used for evaluating the performance of your portfolio.